Hello, everyone, and welcome to HMB's Chicagoland Local Taxes from Audit to Resolution. This is a part of our work from home webinar series. We've done 9 or 10 to this point, and we have a few more in the pipeline. So as we wait for people to join, as we can see they're signing on, I'll run through a couple of announcements. The first one being next week, we will have another work from home webinar series starring the one and only Jordan Goodman, and it'll be the first one of our newest associate, Dakota Newton. They will be speaking on Nexus and specifically Wayfair implications both in the sales tax world and the income tax world now that we're 2 years removed from the monumentous decision of 2018 of Wayfair. So and again, all these are being recorded. They are accessible via the, we send out a link, or we can get you a link to YouTube where you can watch the video, and also we can get you a copy of the slides as well.
Yeah, these are going to qualify for CPE. We have noticed in the past that some people have had issues with the polling questions showing up. You do have to answer those to get credit. If you do have issues, reach out to us and we will get it resolved afterwards. It's not an issue, so don't fret.
Yeah, and I think I should have done this probably first. I should have introduced ourselves. For those of you that don't know me, I'm David McAmer, and I will be presenting with my colleague Samantha Breslow today. All right. And I think with that, we'll get started. So what we're talking about today is we all know that local taxes can be a thorn in our side. What we're going to focus on specifically today is Chicagoland taxes, with a heavy emphasis on the city of Chicago and Cook County. This is a presentation that if you attended our brewery series in the past, Sam and I have spoken on this topic. The city and the county both keep our professions pretty engaged and ready to counsel and advise our clients. They've kept us mighty busy the last couple of years. And what we're going to do is we're going to go through some of the substantive issues with some of the taxes. We'll also touch on a little bit of audit and some procedural measures as well. There's going to be a heavy emphasis on the Chicago lease tax, the amusement tax, the Cook County gasoline tax, and the Cook County parking lot tax. And we've focused or honed in on those 4 taxes because that's where we have at least seen the most activity as of recent. So background and authority. If you've seen me give this presentation before, I say this every time that I speak on local taxes, and this is one of my take homes for anyone watching. When I attend a webinar, I enjoy, heading into that webinar or heading into that session, and I attempt to take away 2 to 3 takeaways. Well, if I was advising people listening as a takeaway, this is my first takeaway, and that's every time you're dealing with a local jurisdiction, I would ask 2 fundamental questions. One, what are they seeking to tax? Where is the ordinance support, and what is the type of thing that they are attempting to tax, whether it be a lease tax, gas tax, tobacco, etc. And second, and very importantly, is do they have the authority to tax that? What do I mean by that? Well, we have in Chicago and Cook County what's referred to as home rule authority. And what home rule authority does is it gives locals jurisdiction and discretion to implement some of their own rules and laws. Here, it's specifically in the context of tax. They have oftentimes the authority to implement rules and laws that are aimed at generating revenue. So when we look, where does that authority come from? Typically, it stems originally from a state constitution, and then also you have to look to the general legislature. So the legislature will spell out a little bit more specifically what a home rule does and doesn't have authority to tax. In Illinois, we look to the Illinois Constitution, and it grants counties who have a chief executive officer who's elected. Those are counties that have home rule authority. So with Cook County, we have Board President Tony Preckwinkle. And then in municipalities with a population of over 25,000 inhabitants, those also have home rule authority. So that's where Chicago and Cook County gains its authority to implement certain rules, but that's not unbridled authority. And so that's where we have to really dig in to see, okay, what they're seeking to tax, can they tax it by their ordinance? And we've seen in the past with Chicago, specifically, there have been instances where maybe their ordinance didn't permit the taxation of something. And so they've attempted to, what I view as sort of a workaround, they've implemented or issued some kind of bulletin or ruling that sort of explains what they deem to be their authority to tax. And so that's really something as a tax practitioner, whether it's in-house or counseling others, you have to be mindful of do they have the authority. And I think many of us on this call, if we've dealt with indirect taxes, other common home rules are obviously the Colorado's locals, both at the city and county level. There's a number of home rule authorities there, and also the Louisiana parishes. So like I just said, they don't have unfettered authority to tax whatever they want. And so when we look to the Illinois Constitution and the legislation, we see that the Illinois Constitution specifically prohibits localities from imposing a tax upon occupations and earnings. So what do we mean by that? Typically, how you can sort of think about that is, are they imposing an income tax? Now, whether Chicago ultimately gets an income tax one day, I think that's another question, and it's not something that I think is unforeseen in some time in the future due to budget deficits. But currently, as of right now, there is a prohibition on tax upon earnings of occupations. Now, the statute does identify certain exceptions to this rule. It identifies alcoholic beverages, cigarettes, hotel occupancy, sale or transfer of real property, and lease receipts. So that's where we see some of the taxes that the locals impose stem from. I still think, though, there's an open question. You still can't tax, at least I would argue, that just because there's an exemption to tax alcoholic beverages, that doesn't give them unbridled authority to, say, tax the income of a company that's in the business of manufacturing and selling alcoholic beverages, as an example.
Yeah, and this is what we frequently raise in the context of litigation, something we kind of keep in our back pocket. So it's certainly a hot issue.
And so what are we talking about? So we just wanted to identify the great number of taxes that are at least on the books in Chicago and Cook County. And as you can see, if you're joining this and saying, well, how does this apply to me? You look at taxes, there's also real property, but we're focusing on the indirect taxes. There's a number of categories where the city and the county are able to Evanston identify here, and we'll get to that in a bit. I think with that
before we get into the substance, let's do our first polling question. So our first question is, have you attended any prior HMB webinars? Is this your first one? Are you someone that's been attending all of our webinars? And we'll give this a couple of minutes here to load. So it looks like most people have attended at least one. So this is maybe their second or third. So that's helpful. All right. So next we're going to move into the Chicago Personal Property Lease Transaction Tax, which Dave mentioned is probably the tax we have seen the most activity with recently. And that's for a number of reasons. But the the lease transaction tax is imposed upon the lease or rental in the city of personal property, or the privilege of using in the city personal property that's leased or rented outside the city. So it's a two-part component there, and there's a different rate depending upon whether it's for a non-possessory lease of a computer at the 7.25%. And be aware that was recently increased. Dave and I were just discussing, as of January of this year, it increased to the 7.25%, versus there's a 9% tax on receipts or charges for the transfer or possession of use of personal property. So that's more if you're more your normal type of lease of equipment or some sort of property. Now, with that 7.25% rate, there is a bit of debate with the department as to whether that 7.25% applies to all non-possessory computer leases, or whether it just applies when the data is supplied by the customer, meaning if the data is supplied by the lessor or the provider of the software, then the city will sometimes take the position that the higher rate should apply. They sort of use it as a negotiation tactic. And I know, Dave, you had mentioned that you've had some success getting the department to reduce the rate to the lower 7.25%. But that's often something we've seen. And so I wouldn't find that surprising if you're in the course of an audit and see the department try to apply that higher 9% rate to non-possessory computer leases when it arguably shouldn't apply. But as far as sourcing goes, we have the Mobile Telecommunications Sourcing Act, which is kind of a hierarchy test that first looks to the residential address or the primary business address in Chicago based on credit card or billing address. We have our first primary case. Dave, do you want to get into this, the Hertz decision?
Yeah, I was getting some feedback that my audio's not,
Okay.
Is that occurring on your end, Sam, as well?
It was, but really only when you were getting into the kind of list of taxes. So I'm not quite sure if anything's missed out so far. If I see it acting up, I can sort of try to cut you off.
Okay. This is one of the challenges from working from home. I have 3 children. All 3 are probably streaming something on their device. So I just sent a text down to my wife asking that they stop streaming. So we'll see if that fixes it. But if not, Sam, alert me, and then I'll switch my video off and we'll go from there. So one of the more recent lease transaction tax developments was in the case of Hertz Corp versus City of Chicago. And this is a great this is a great case for Chicago taxpayers. And what this was is the city put out a ruling number 11, which according to their interpretation, permitted them to impose the lease transaction tax on any rental of a car, a rental car. So it Hertz that was located outside of Chicago, but within 3 miles of the city. So if you're a Hertz location, you're located in, say, Evanston at a location that's within 3 miles of the border. An individual comes in to rent a vehicle from your location, and they show you a driver's address, a driver's license that shows you a Chicago license, then what the city said is, we are going to automatically assume that that lease is going to take place within the city of Chicago, and therefore the lease tax is due. But what the problem was, and what the taxpayers ultimately argued and advocated for, is that the tax should be imposed on actual use and not on potential intended use. And so ultimately this went all the way up to the Illinois Supreme Court, and the Illinois Supreme Court agreed that ruling number 11 was invalid because it was stated on an intended use to use the vehicle in Chicago based on Chicago residency rather than an actual use. So again, this is a great case for taxpayers. And this is one that really restricted the home rule's ability to assert an extraterritorial or a tax with extraterritorial effect.
Yeah, it's also a good example of the city, which we're going to mention probably time and time again today, the city trying to expand or clarify their ordinance via a ruling and being shut down by the court. So that part of it's kind of fun as a practitioner to see.
Yeah, now what this case, where this case can be particularly useful, and Samantha's going to get into this in a minute. Well, the city has expanded. Well, I shouldn't use the word expanded because the history permits them, at least back to the 90s, to tax non-possessory leases. So those leases that are up in the cloud that don't have a tangible effect. But what this case is also very helpful because, and what Sam's going to talk about in just a minute, is even when we're talking about SaaS and PaaS products, service as a software, platform as a service, we need to focus on where the actual user is. So even if you have a company that's based in Chicago and has a tech facility and it's leasing some kind of product, we need to actually look to where the users who are using that SaaS product are located. And so Hertz, even though it applied in the context of tangible personal property, has a lot of application with the SaaS products, which Sam will jump into here.
Yeah, and that'll be definitely within the course of Labelle, which we'll explore later on for sure. But yeah, so we focused more on the lease of personal property with the Hertz decision equipment. And as Dave mentioned, there's also this really complicated part of this with the non-possessory computer lease. So I kind of want to walk you through the background of what happened to give you some sort of understanding of where we are now. So the Lease Transaction Tax ordinance was adopted back in 1974. And at that time, the ordinance include language that it applies to lease time for the use of computers. In 1994, we have a decision in the Meets case, which came out of the Illinois Appellate Court and determined that for some of you maybe that are maybe less aware with what LexisNexis is, but law firms use it for online database searches. And they determined that those searches, that platform, was subject to the lease transaction tax as lease time for the use of computers. And again, that was in 94. Right after that decision, they amend the ordinance to include this non-possessory computer lease language that we have today. And I think that's important, the timing of this, because in 1994, could they really have understood where the city was ultimately going to apply it now? So what I mean by that is in July of 2015, rather than amending their ordinance, the city issues ruling number 12, which states that a non-possessory computer lease includes many sort of SaaS or cloud-based products: cloud computing, cloud services, hosted environments, software as a service, platform as a service, and infrastructure as a service. So again, rather than amending their ordinance, they say, no, we're just clarifying. It's always been taxable, but a non-possessory computer lease includes these items. And I'm a bit skeptical with that interpretation, considering that in 1994, when they added the term non-possessory computer lease, the most SaaS type companies didn't exist. Salesforce, which is arguably the largest cloud-based company, didn't exist. AWS and Slack, they weren't even created until the 2000s. So I disagree with the department's interpretation, but the bottom line is within the context of audits, they will try to apply this far before this 2015 ruling number 12 and seek to apply it to years even further before that. I mean, I think the earliest I've seen is probably 2010, where they've tried to go back because the city has a 4-year SOL plus 2 years if it's substantially underpaid. But to get into ruling number 12 a little bit further, they do provide specific examples of what some taxable charges include. So the first being performing legal research. That's the Meets case. That's what we just talked about. Obtaining consumer credit reports, obtaining real estate listings, performing functions such as word processing. I mean, frankly, these examples seem a little antiquated to me and are not nearly as advanced as some of the products that the city has applied it to within the course of audit and litigation. There was go ahead, Dave.
So I just have one comment that ties in what you just said. So we had a client not too long ago that was subject to an audit, received a significant assessment. This is a large company that does have some SaaS products. And really, there was a miscommunication on what the actual service was that was being provided. And so they received a significant assessment. And once we got into litigation, we had someone from the business come in and explain exactly what they were providing, because on the invoices, it said remote hosting. So as soon as the auditor saw remote hosting, they just automatically assumed that that meant it was a SaaS product subject to their tax. And so they went back 4 years, and they went back into, it was 2013 time period and going forward. And, or it may have even actually been 2009. I think 2009 was the first cycle. It went 9 to 13 and then 13 to 17. So we went all the way back to 2009, where they tried to impose this tax on all invoices that said remote hosting. Well, when we got a couple engineers in from the company and business representatives, we sat down with the auditor and opposing counsel and explained remote hosting wasn't what we think of it now. It wasn't where this company was providing some remote website hosting and they were providing SaaS. But what remote hosting really meant was they provided on-site IT tech for various companies. So they would send one of their employees who would man a help desk at the business site, and that's what they considered to be remote hosting. So it was completely service related. So if someone had a problem where their laptop, one of the applications wouldn't boot up, they'd go take it to the help desk, someone would service it, and that's what the fee was for. So I think it is really important when you get into these audits to explain exactly what the product is that you're offering, because there's ultimately going to be some misunderstanding. And to Sam's point, what we know about web hosting today in 2020 and SaaS and PaaS and all these remote products is not the same as 2015. And in fact, that's what the website engineer told the city. I was sitting in the meeting and he said, look, we didn't even offer SaaS in 2009. Like, that product did not exist. It exists now today, but that's not what we're talking about. So just be clear with the auditors and opposing counsel with what the product is that you're talking about.
Yeah, that's a great point. I've worked with taxpayers who have sort of just assumed that what they have qualifies as a non-possessory computer lease. But I think it's worth often taking a step back and really trying to determine whether it actually applies. And one of the ways we've done that is we have connections with the city, the legal counsel. Many people may know Wes Hanscom, and we were able to just sit down, have a meeting, actually walk him through the platform and show it to him to get his advice. This was in the context of audit, whether it should even be subject to tax. So often you can sort of maybe bypass or make the process more efficient by just reaching out to the correct people. I think that's really hammering that slide on lease transaction tax. There are also exceptions to when it applies. So, or exemptions. One of those exemptions is ruling or exemption 11, which contains a de minimis exemption that provides if the customer's use or control of the computer is de minimis and the related charge is predominantly for information transferred to the customer rather than the actual use or control of the computer, the lease is exempt. So what does that mean? Well, the example they provide within ruling 12 is receiving price quotations. But the idea behind it is you have to be exempt, the information has to be delivered passively with a minimum search functionality. So that's kind of what I often look to whenever I'm helping a taxpayer decide whether this exemption will apply, is whether there's sort of a search functionality within the platform. Ruling 12 also clarifies that a legal research database would not qualify under exemption 11, but we already sort of know that, again, because of ruling 12 and the Meets decision. It's more or less resolved. Dave, do you want to sort of explain this more than 50% rule?
Yeah, so this is the bundled charge is a concept that many of us are familiar with in the indirect tax world. And what the bundled charge means, that if you have a product, let's say tangible personal property, but you're also providing a service with that service and maintenance. So let's say you're providing a copier, but you're also servicing it. And let's just say on the invoice, it's a bundled charge for one price. Well, we already learned that per the service occupation tax, the city does not have the ability to tax services. But if that's a bundled charge that's not separately itemized, then the entire charge is going to be subject to the lease transaction tax. And now there is, if you read the ordinance closely, it does permit you, even if it is bundled, to show by clear evidence that more than 50% of the charge is for a service. So that is another suggestion I would leave out there to anyone listening, that if you are hit with a assessment or the auditor's questioning a charge, and you try to mount the argument that, well, this charge actually includes service, not just tangible personal property, and the auditor comes back and says, well, it's bundled, so the whole thing's subject to tax. If you have other items in your books and records that's able to show that more than 50% of that charge is in fact for services, then I suggest digging that out and presenting an argument to the auditor that the charge is exempt under the more than 50% rule that's contained within the ordinance. But more specifically, in the context of non-possessory leases, one of the notes that tax ruling number 12 made is that they kind of did away with the more than 50% rule in the context of SaaS and these cloud computing products. And what they did there was they provided for an apportionment methodology. So if you're a lessor of these SaaS products, you can provide this. The Chicago has a form. It's an affidavit. You provide that to your customer and say, hey, I understand that I am leasing you a SaaS product, but I understand that not all of your users are in the city of Chicago. And the customer may say, they may take a look at their books and records and say, yep, 60% of these users are outside the city. They provide an affidavit. They hand it back to the lessor. And essentially what this permits the lessor to do is, rather than tax 100%, they can tax 60% of it based on the affidavit. So we often get the question from clients that say, well, our customers give us serious pushback about taxing them 100%. Followed up, we ask the follow-up question, well, have they given you an affidavit? And if the answer is no, that's what I advise the company to start with. Tax 100% unless their customer is willing to put themselves on the record and say, hey, 40% or whatever the number may be are outside the city, because that's the type of proof that you're going to want to provide to the auditor during the audit. I will say we have been able to provide some pretty good detail with pings on IP addresses that show the users are outside of the city. I know that can be a challenge for certain customers to pull that kind of minutia and that kind of detail, but that is something that we have used with the city as well, where we didn't have the affidavit. One other quick note. So we did receive, at any time, if anyone has a question, you can submit that and we'll do our best to address it. We did receive a question that blends the lease transaction tax with other taxes, specifically in the context of bundling. And the question was, what if you provide a product or a product and or service where it invokes two of these taxes? So the example was used maybe in the gaming industry. You're providing tangible personal property, some kind of sports game to someone, to one of your customers, but then also with that, you have a streaming capability that may be subject to the amusement tax, and you just bundle this as one price. I'll say my thoughts first, and I'll leave it to Sam. I don't have a great answer for this one. I think if the city sees the bundled charge, they're automatically going to assume that the tax, that the entire charge is subject to the higher tax. I would be surprised for them to say, nope, it's not subject to the lease tax of 9%. It's subject to the amusement tax of whatever that rate is. But I would push back on that. And if you can show in your books and records where that charge is segregated, at least within your own books and records, even though it's not segregated on the customer invoice, I would say, hey, look, X% is for the game and it's subject to the lease tax, and then X% of the charge is subject to the service charge, and so we're going to charge the amusement tax on that. But you just have to have pretty good books and records and be able to support that position. Sam, any thoughts?
I agree. I think the only thing I would add is ruling 12 does specifically get into bundled charges and says when a charge is bundled, it includes both taxable and non-taxable elements, and they're not separately stated, the entire charge is taxable unless you can clearly prove that more than 50% is not for the use of the TPP. So I agree. It just really comes down to books and records, but I wouldn't be surprised if the city tried to apply the higher rate because they need revenue, so they're going to do it. This kind of leads us back to the timeline that we were following with the lease transaction tax. So we talked about ruling 12 that was put out in 2015. They subsequently put out a clarifying bulletin. And I think the only thing I'll really say about that is within the ruling itself, the city even concedes that many companies, quote, may not have been aware of the scope of the tax, which I like to use that to my benefit, whether it's in the context of arguing for penalty abatement or arguing that it shouldn't even apply in the first place. If the city is conceding that there was ambiguity as to whether the lease transaction tax applied to non-possessory computer leases. Also within that ordinance, they clarify that the lower, at that point it was 5.25, now it's 7.25. Non-possessory computer lease rate applies if, again, the information is being provided by the customer or supplied by the customer. So that was really the impact of that. We also have a revision to that ruling in February. So the ordinance does apply or does provide a lease for release exemption. So like the ROT, a lease for release exception applies. But however, for the exemption to apply, the property released must be the same property, meaning that if the taxpayer modifies or transforms the use of the property, the exemption isn't available. But what they kind of clarify in this February amendment to the ruling is that whenever you are in the context of a cloud computing products that are incorporated into the sublessee's products, then those are exempt. So you don't have to follow that same property rule. They are exempt. So it's sort of, they expanded, I think, the scope of what was potentially exempt under the release exception.
Yeah, I think I'd add there, basically this piggybacks on what a lot of states, including the state of Illinois, does, and that's it exempts the value added reseller. So if you're making a widget, if you're making a air conditioner, and ultimately you have one manufacturer that's going to sell the bolt or sell the one vendor the bolts, and the other one's going to do the fan and the blades, and basically all those parts are going to qualify for a resale exemption, and then the final vendor will collect the sales tax from the customer. Similar concept here with SaaS products. I think the city recognize that even in the tech space, there's going to be software that has build-ons or add-ons that another company may add to the SaaS offering. And so there, it doesn't make sense to hit tax twice, to hit tax on the value-added seller, and then ultimately the retailer as well when they sell it or lease it to the end consumer. So I think this was another nice add for taxpayers. And
yeah. I also think it's interesting with the city that, so we already had the ruling on the website, right? And you would never know that this revision was even made to the prior bulletin unless you just go click on it and then it says revised as of X date. It's just another example of, unless you're really paying attention at the city and the county, these things can sort of be changed without even realizing it.
yeah, I agree. And even as I was preparing for this, I clicked on, when I Googled for this bulletin, I clicked on a bulletin that actually had the old one and didn't even have that revised language up top. So it wasn't until I went through the measures of going to the actual Department of Finance's website and clicking on that bulletin that I found the revised one.
Yeah. All right. Well, before we leave the transaction tax, there are a couple hot issues that Dave and I wanted to hit on. I guess I know one issue that I sort of want to touch on that's maybe not within these bullet points is the concept of nexus. I get this question all the time from taxpayers, whether we have a physical presence standard or whether Wayfair applies. And all I'll say there is it is still a very undeveloped or open issue. We do know that within the context of ruling number 12, the city says that they're just not commenting on it, but it's still a really hot issue. Dave, you want to sort of walk through some of these other issues here?
Yeah, so the use of other similar taxpayer data. That's something that we've seen in the traditional TPP space as well as the SaaS space. So here is what happens is maybe a taxpayer's caught off guard and they aren't aware of the tax that's due. And so the city comes in, conducts an audit. The taxpayer is unable to provide some or all of the data. So the city just says, okay, well, we've audited this other taxpayer that's in the same or similar industry. It's the same or similar size. We're just going to use that data and give you what amounts to a jeopardy assessment. And I think there you really have to push back on what they mean by similar taxpayer data. And we never got to this issue in litigation because we resolved it short of this, but we asked opposing counsel discovery and we said, show us proof that this other taxpayer is similar. All we have is the auditor's word to go off that it's a similar taxpayer. But you know, you don't have to provide us the name, but you have to provide us some details about employees, locations, products, price of products, what their products are. And inherently, that's really tough for the audit department to do because they have to do that and try not to disclose other confidential taxpayer data. So just kind of a sticky situation. The other one that we've seen recently is in these informal audit notices. Did you touch on that, Sam?
No, I didn't. Yeah. And yeah, you could also talk about jeopardy assessments and how the city and county do
Yeah.
that.
So what we've seen with, and this is similar with other, these informal audit notices. This is something that Sam and I have both seen with similar clients as of late. But basically they receive this notice in the mail, which isn't even an official audit notice. And I don't have one in front of me, but it basically says, you know, we think you're subject to this tax, send us all your data, and then we'll send you the assessment. If you don't do this by insert date, which is usually 30 days or less, we're going to shut your business down or we'll revoke your business license. And to me, this is I don't know. I think it's a little poor form because oftentimes these are the types of taxpayers that are caught off guard with this, particularly in the SaaS space where this is Chicago SaaS tax is sort of a nuanced and front of the line tax that not a lot of many other jurisdictions impose. And so oftentimes what we have seen is the taxpayer in an effort, they don't want their business to be shut down. So they send all this data and then the Department of Finance will just run with it and they'll assume that 100% is taxable. And their reasoning is because the taxpayer gave me this data, so it must be a taxable product. So before anyone dives into the issue, the audit department has all this data, much of which is completely irrelevant, and they assess tax. And so this recently happened with one of our clients. Fortunately, you know, we were able to sit down with the department and reasonable minds prevailed, but we were able to back out of about 50% of an assessment because 50% of the charges just weren't subject to the tax. And the auditor just ran with the data and said, yep, it's subject to tax. We've kind of talked about the aggressive pursuit of SaaS companies. There's just a lot of gray area for this. And so the city has, it's just an evolving concept. So just be sure that you pin the city down on their position. And then last but not least, the city has started to impose or go after some lessees. I guess this is a little bit more favorable news for lessors. I think typically we would see this with an out-of-state lessor that may have in-state or in-city lessees where the city can go after them, but they have a little bit more challenges when it comes to pursuing the out-of-state lessors.
Yeah, because technically the transaction tax is imposed on the lessee. So if the lessor doesn't collect it, the lessee is still technically liable. And yeah, to Dave's point, we've seen this more recently, which I guess shouldn't be surprising, but it sort of was to me to have a lessee come to this audit because you're sort of at a disadvantage, right? You don't know whether the lessor has remitted. You don't know, maybe you know a little bit about their product, but it's tougher for you to argue that it shouldn't be subject to transaction tax when it's not your product. We had to sort of do some research into some of these items on behalf of the taxpayer. But yeah, definitely something to be aware of.
Yeah, we had one other quick polling question, or one other question posed, and the question was along the lines of, if in fact you offer TPP, but you also are offering a service, what are the types of books and records that you're able to show that will support your case that some of this is for a service? And this question was specific to the medical field. One of the suggestions I have is talk to, if you're on the indirect side, talk to your income tax people or your accounting folks as well, because they may have financial records that talk about the income. They may have segregated cost of goods sold with regard to TPP. So you may be able to come up with some of that information that shows, okay, here's how we can segregate our service income versus our income for selling a tangible product or widget. Also in the medical community, I know that Medicare has a lot of restrictions. So if you're in that space, and a lot of documentation requirements when dealing with the government. So maybe some of those records might help to show what some of those costs are of the actual TPP versus the services that you're providing.
Yeah, and I guess we haven't got into this so much, but again, the lease transaction tax is imposed upon a lease. So any sort of service or sale shouldn't be subject to tax. I dealt with an audit a few years back where they were leasing TPP, but also providing some non-taxable services like maintenance, labor. And we tried to argue that those services were non-taxable. The issue being, in order for them to be non-taxable, they have to be separately stated and optional. And that can be difficult to prove. In our situation, the contract clearly separately stated these items, but whether they were optional was a much harder argument. And we ultimately looked outside really of the agreement. I mean, we pointed to language within the agreement, but then just tried to argue that, come on, these things must be optional. They can't possibly be performed by anyone else just by the nature of the business. And ultimately the city bought into it, and they were pretty flexible there. So the idea being, look to the contract, not just the invoices. The ordinance doesn't actually specify whether it needs to be in the invoices or the agreement.
Yeah, so with that, I think lease tax takes up the most time. We got about 20 minutes left, and let's just touch on some of these other taxes that are popping up.
Sure. I'm going to try to cruise through the amusement tax then, so we have time for all of these. So a few things to note with the Chicago versus the Cook County amusement tax is that they're very similar, but there are pretty important differences. So they're similar in that they're both imposed upon the patrons of the amusement, but the owner, manager, operator is required to collect it. It's kind of like the lease transaction tax. And they both define an amusement as any exhibition, performance, presentation, or show for entertainment purposes. And then they provide a bunch of similar examples. Things that you would think would be subject to an amusement, like a movie, right? A picture show, or a performance of a theater. They're similar in that respect. But where they're different, there are a few key ways. One is paid television programming. So the Chicago ordinance explicitly provides that it's imposed upon paid television programming. It's within the actual language of the ordinance, and then they even clarify it within a 2016 bulletin. Versus the county never had any sort of language like that in their ordinance. They came out with a ruling trying to impose it on paid television programming, got a whole bunch of backlash from hotels and restaurants in the city, and then ultimately repealed it in April of this year and announced they were no longer going to be required to collect amusement tax on paid television. So that's an important development that was not that long ago. Electronically delivered amusements are also a key difference. So in 2015, the city of Chicago released amusement tax ruling number 5, where they asserted that it's going to apply to the privilege to witness, view, or participate in amusements, not only in person, but also amusements that are delivered electronically. And in that ruling, they clarify a few types of electronically delivered products that would be taxable, like television shows, movies, or videos. So your Netflix, your Hulu, electronically delivered music, so Apple Music, Spotify, or the privilege of participating in games or online. So they kind of outline that within the ruling, and that is what is ultimately at issue, or was at issue in Labelle, and is at issue in Apple, which I'm going to sort of breeze through on these next couple slides. The last key difference I want to point on between the two is that both have a small venue exception. So both say that admission fees to witness live theatrical, live musical, or live cultural performances are exempt, but the capacity is different with the city versus the county. So with the city, it's only if there's a maximum capacity of not more than 1,500 people, but with the county, it's not more than 750 people. So again, just important to note that there are differences between the two. And then I think another key difference is that the city in a ruling touched on whether something might be primarily educational. And I know Dave has had experience with that.
Yeah, I'll give you a quick break to catch your breath, but two quick things to note on this. I think there's a lot, what I've seen is there's a lot of discretionary used by decision makers when deciding what qualifies as an amusement and also what qualifies as an exemption for the literary use. But two quick examples. On the Chicago side, I submitted a private letter ruling for a company that provided tours that were primarily what I deem to be educational. In fact, more than 50% of their amusement charges, something like 65%, were from schools. So they were providing an educational tour. And we got down to the very end about trying to decide whether this was subject to the amusement tax or not. And the question was posed to me, well, how do they get around from site to site? Because at first they thought they were walking. It was a walking tour, but then they later found out that they were being driven in a vehicle. And for some reason, the fact that they were being driven in a vehicle, which had air conditioning and additional sound, that turned it into an amusement, whereas the city told me if in fact they were walking, it wouldn't have been subject to the amusement tax. I don't understand the distinction. But similarly, there was some litigation in Cook County where DJing was at issue and whether that qualified for the literary or artistic exemption. And there, the judge, in a written opinion, which was ultimately quoted in the Chicago Tribune, looked at DJing, and in her eyes, that didn't view as artistic or literary exemption. And so there was a little bit of heat that she took for that. And that was, like I said, in the Tribune. But the point is, there's just a lot of discretion oftentimes when it comes to deciding what an amusement is. It's easy when you're going to a Cubs or a Bears game. But when you're talking about some of these smaller events, that's where it gets a little bit trickier.
And I think that's a good example of kind of using your connections within the city to get an answer. You can always apply for a formal letter ruling, but in that case, Dave was able to just kind of use his relationship with Wes and the city of Chicago to get an answer, which is something we like to do to try to make the process more efficient. Okay, so Labelle, I'm going to give you one sentence what Labelle is about. And it's the fact that the city can tax streaming services. That's what the Illinois Appellate Court decided. It was ultimately not taken up by the Illinois Supreme Court. There are a bunch of issues. If you're interested in hearing about it, Dave Hughes and I previously did a webinar on ITFA where we covered Labelle. So if you're interested, you can go online and find that. Apple is same issue. Apple's different in that whereas Labelle, there were individuals that subscribed to Hulu, Netflix, Apple Music. So it was streaming TV and streaming music. Apple's just streaming music. It's currently at the Illinois Circuit Court. It was sort of put on hold while Labelle was being decided, and now they're going to finish. I don't know. There's differences between the two. I mean, again, one is music versus the other one was a bunch of different types of streaming services. But a lot of practitioners think that ultimately the court's going to reach the same decision. And again, if you want to hear more about that, go listen to our webinar that we had on ITFA. One more important thing about Evanston. So I get this question all the time about whether other cities have similar taxes to Chicago. So whether it be the Lease Transaction Tax or the Amusement Tax. So Evanston already had an amusement tax. They already imposed a tax of 5%, very similar to Chicago and Cook County's ordinance. But they recently, as of June 8th, adopted a provision to expand the definition of amusement to include paid television programming and streaming audio, streaming video, and games. So a lot of practitioners, including me, think that the same arguments that were made in Labelle and are being made in Apple will potentially be made by other taxpayers in a challenge of this Evanston ordinance. Would love to challenge it. I think it's wrought with issues. So feel free to reach out if you have any questions about that applicability. But the idea is it may have opened the floodgates. There may be other cities that will adopt similar ordinances if they have the home rule jurisdiction that Dave talked about in the beginning. So getting into the gasoline tax.
Yeah, so the Cook County gasoline tax, if you ask anyone in our group 5 years ago, 6 years ago, we wouldn't have much or any experience litigating cases with Cook County. that has all changed in the last 5 or 6 years and has kept many of us very, very busy. And one of the things that I have seen happen, especially in the context of local jurisdictions and local jurisdictions specifically that are starting to get into more sophisticated issues that may not be, that may not have the most experience with those issues, is they start taking very aggressive, unsupported positions. And reasonable minds will differ on this, but I think the county has taken some very unreasonable positions in a number of cases that we've been involved with, some of which are pending at the circuit court on appeal. But specifically in the gas tax, let me just give you a highlight of one of the issues here. So if you look to the Cook County gasoline tax, the tax is imposed on the retail sale in Cook County of gasoline at the rate of 6 cents per gallon. So let me give you an idea of what's going on with our client. So you may have a business that's located in Texas that doesn't have any refineries in the Chicagoland area. So they don't have any inventory there. So what they do, and this is common in the oil industry and the energy industry at large, those companies in those industries will buy and sell respective energy with each other. So we have company in Texas that doesn't have an inventory position at a refinery or terminal in the Chicagoland area. And then we have another customer who may be located in Chicago, but doesn't have a refinery or a terminal in Texas, and they may need to provide fuel to one of their customers. So what happens is a company will agree to purchase a product at a future date. And let's say that future date comes, and at that time, they no longer need the product for whatever reason. The demand isn't there. So they say, oh, I don't want all these gallons of fuel because I don't have anywhere to put it. So they talk with the company that was going to sell it, and that company says, oh, well, sure enough, I was going to buy fuel from you in Texas, but I don't need that either. So what we're going to do, we're just going to cancel it out. We're going to swap it out. Now, what happens is there may be little price differences depending on when they entered that contract. So there could be money in dispute that needs to be paid. Well, what the county has done with this type of transaction, there's been no tangible product that's been exchanged. The county says that that's a sale of gasoline, even though the ordinance states pretty clearly that the tax is imposed on gasoline. They have mounted multiple theories that that's really the intangible rights to gasoline, or alternatively, that because money was exchanged, that's a sale of gasoline. So really, I think what we advise people is push back on that. Read the ordinance, see what it imposes tax on. Similarly, another issue that's happened in the tobacco tax area is when you have an out-of-county dealer, retailer that may come into the county to pick up product and ultimately sell out of county. The county looks at that transaction and says, hey, the sale happened in Cook County. And even if you present evidence that you were a wholesaler taking it outside the county to sell, even if you provide evidence that you did in fact sell it outside the county and paid the applicable tax, whether it be motor fuel or tobacco out of county, the county still takes the position that the sale occurred in the county and that tax is due. Why don't we flip slide, Sam? So parking lot tax, another one that I wanted to touch on. This is another one that a lot of people didn't have their eye on as of a few years ago, and this is one that Cook County is aggressively pursuing. They're aggressively pursuing it in a couple of spots. One is for that parking lot that maybe you have excess capacity and you just need to earn some money on the side as the business and you have excess space. We see this oftentimes with a company on the outer skirts of Cook County where they have space for truckers, and truckers will come and park their semis there for $50, $75 a month. In that instance, parking lot tax is due. But the thing that they're doing is they're going back 7 years, and they're just automatically assuming that your spots were filled 100% for those entire 7 years. So they're assessing these huge jeopardy assessments. So just be aware of this tax. If you have clients in this space, I'd advise them to start collecting immediately and keeping books and records. But the other issue that they're taking with this is they're imposing tax on no charge parking. So what do I mean by this? Outer skirts of Cook County, particularly near O'Hare, you'll have large office buildings where tenants will have a number of parking spots included in their lease agreement. There is no separate charge for this parking spot, but in the county's mind, nothing is for free. So what they will do is they will look at those lease agreements for the lease of the actual real property, and they will impute a portion of that to the parking spots. And so we have seen this activity. This is currently being litigated as well at the administrative hearings. But again, they're imputing a price of that property, the charge for the property tax on the parking lot. And they're saying nothing's for free, you're subject to parking lot tax. And those have resulted in some really large assessments because like I just stated, Cook County has a 7-year statute of limitations. And when you have parking lots of say 200 to 300 spaces, that really adds up quickly.
All right, that leads us to our second and final polling question. So for those of you who have stuck around, good. And let me move to our second question, which is, have you ever handled a Chicago or Cook County audit? So we've been discussing all these different taxes because I think we think there's more value in you just sort of understanding how this could possibly apply to you or your clients. With the remaining few minutes here, we're going to give some of our kind of advice and tips and tricks on the audit/litigation process. And I'll release the results. So it's sort of across the board, but most people have dealt with a Chicago or Cook County audit.
I like the feeling lucky bunch, so I hope that luck stays true. So real quick, what we've seen with procedure and litigation, what we want to focus on, because oftentimes, unless you are a legal practitioner, the protest procedure is left predominantly to the law firm. So I don't want to get into what happens there, but something that you must be aware of when you're dealing with the county or the city. Specifically the county protest the time to protest an assessment is very limited. You have 20 days from the date of mailing, and they will not give you any kind of break if it gets stuck in the mail, if it goes somewhere else, whatever.
They sit on it for a week before they mail it.
Yeah, or if they mail it the day before Labor Day and it really doesn't get out until 3 days after Labor Day, you've just lost 10 of those 20 days. The city has a 35-day rule, and there's actually a discretionary period. If, in fact, you miss that, you can request a discretionary hearing. You may have to pay the assessment under protest, and you still have to get the administrative hearings to sign off on that. But you do have a little bit of recourse with that. Regardless, you don't want to miss the 35-day timeline either at the city. What's generally included in the protest? The good news is the forms are fairly straightforward. So if you're short on time, you can get the general information, the tax type, the tax periods, the amount, attach a copy of the assessment, and just put a couple sentence explanation just to get it on file. You can always amend it once it's on file. But it's very important that you create the record at the administrative level. If in fact you have to litigate this beyond the administrative level, because as many of us know, this may be a home rule court for these jurisdictions, you aren't going to have the opportunity to create the record at the later level. So you have to do it here. And just on that point, county, you have very limited discovery. Most of the discovery happens at the actual hearing. That's where you're talking to witnesses for the very first time. We had a hearing where we talked to an expert witness for the very first time on the stand. Raises some procedural and due process issues. We'll see if a circuit court and appellate court ever opines on that. The city, though, generally, they have more procedures in place. And this just goes to show that they've been doing this a lot longer. They've been attacking substantive issues more reasonably a longer time. The county's just starting to get up to speed. And why are they getting up to speed? They need revenue. Those of us that have lived or read the papers in Cook County see that there's a significant budget deficit.
Yeah, so whereas in the county, you don't have the Illinois rules, Supreme Court rules, so you don't have the right to discovery. In the city, they at least adopt Illinois Supreme Court Rule 201H, which allows for discovery, which is just an example, as Dave said, that the city is sort of more akin to litigating in Illinois and more of a kind of established or organized process.
Yeah, and I think, and then after hearing, you have 35 days to appeal to the circuit court, which acts as an appellate court, and that's going to be a review on the record. So with that, I think we're at our time. We thank everyone for joining. We can provide a copy of the slides. I don't know if that's sent out automatically, Sam, or if they request a copy.
It's upon request. So if you would like them, reach out to either me or Dave or Jason. You can see his name there and we can provide them to you.
Yeah, but thanks for joining, and we hope that you tune in next week.
Yeah, thank you for joining us.
And happy tax day. Thanks, everyone.